Thank you, Hampton. Let's bring in Representative Joe Sestak. He's a Democrat from Pennsylvania and Vice Chairman of the Small Business Committee. Michelle Bachmann is a Republican from Minnesota serving on the Financial Services Committee. Representative, it's great to have you with us. Michelle, I'd like to start with you.
Thank you, Melissa.
It seems like we got into this mess in the first place because of our inability to measure systemic risk, and yet this regulation, if it's put in place, doesn't make any effort necessarily to better measure risk in the system.
Well, it's interesting because if you look at risk, take a look at the risk that the federal government has been taking over the last year. Bloomberg says that we've seen the federal government commit itself to about $10 trillion worth of taxpayer money. It's the government that is taking all the risk with the people's money, and government isn't reforming itself. It isn't reforming Freddie and Fannie. It isn't reforming Community Reinvestment Act.
That's a fair point, Michelle, but in terms of this specific regulation that the Treasury Secretary is proposing, does it get us any closer to actually being able to measure risk in the system? Because as many regulators we have out there, if they can't actually measure risk, it doesn't get us anywhere.
Well, we're looking at a number of new expansions, hedge funds, equity firms, for instance. I think we need to fine-tune what we've already had with regulators. It isn't that there was an absence of regulators in the system. We need to look at what went wrong there before we start to spread that beyond to these other new areas. I'm very concerned about the Treasury Secretary wanting to expand his plate right now by being able to go in and take over private companies and set wage compensation. This is a bold measure, and I think we have to proceed cautiously.
And to say the least, that's the understatement of the day. Second only to the idea that we didn't just invent regulation over the last couple of weeks. Representative Sestak, now talk to me about how we can do this rationally without just coming up with haphazard kind of regulations and clawbacks and the anger rhetoric that we have been seeing, punishing people for making money, going after really where the problem does not lie, which is the bonuses, and letting kind of the banks slide on this. What are your proposals that are going to be proactive and not involve 500 new regulatory agencies?
Absolutely. We don't need more regulation. We need smart regulation that's transparent. Back to Melissa's point, systemic failure. The U.S. government has $3.6 trillion budget this year, and people watch us. You ask us a lot of questions. 10 years ago, we did not have any credit default swaps. 1 year ago, we had $68 trillion unregulated. Now they're down to $68 trillion.
So
do you
Joe,
want oversight over that? I think so.
Joe, sorry, but just to get back to the original point, you mentioned systemic risk in our ability to measure it. If we are to increase the amount of regulation, if we are to increase those kinds of firms that we regulate, do we get at that issue of actually getting our arms around how much systemic risk is out there?
Absolutely. And my next point would be, you do if you place it in the right place. That's the Federal Reserve, because it has the understanding, it has the expertise, and it's independent. And what you want to do is to begin to collect the data. For example, we do not have these hedge funds, of which an individual or several of them could cause financial damage. They don't report their information in any way. So how can you do anything if you don't have the information?
But to that point, 10 years ago, we did have long-term capital management. 10 years prior to that, we had the portfolio insurance that caused the '87 crash. There's always another crisis somewhere, and we're always one step behind the game, and we keep ladling on and layering on new regulations. None of them seem to actually stop the problem. They just give hedge fund operators something else to work around.
To your point, it was the lack of regulation this time that permitted us. Remember, it was where we did not have regulation as Lehman Brothers went down because AIG had not kept the proper reserve because there was not the regulation for it to keep X amount of reserves. That's where the damage was. We had no insight, much like the chairwoman in 1998 of the Commodity Future Trade Commission said, till she was pushed aside by Democrats and Republicans. We have to have insight, oversight, because if there's anything I learned in 3 decades in the Navy, expect what you inspect. And there was no inspection in the damaging areas that you mentioned, Jeff.
Well, and let's turn this back to Michelle. Michelle, how would you go about answering basically the same question, which is how do you stay one step ahead of people who are incented wildly out of proportion to anybody who would regulate them? You're talking about people who can make $50 million being inspected by guys who make $50,000.
But here's part of the problem. We're looking at the government to take on more insuring of risk. The FDIC would be the ones that would be charged with insuring against this risk. This is a problem. Member banks, for instance, saw huge increases because they had to replenish the FDIC because the FDIC had gone so low. And again, we'll have a fractional reserve system within the FDIC where the hedge funds and equity funds would have to be paying fees into that for that oversight regulator work. Again, this is new territory, but it's the government, again, having to step in, do the insuring. That was initially, again, part of the problem with Freddie and Fannie. It was the government that had the implied backstop, and which now we all know became explicit. I'm very nervous about the government putting more on its plate. We can't handle what we have now.
I'll see your nervousness and I'll brave you. Horrified is what I am.
Representatives, thank you so much for your